Hi everyone, my name's Daryl Payne, CEO at As Good as Gold Australia, and today, once again, I'm joined by my brother Brian and partner at As Good as Gold. And today we interview John Adams, Chief Economist at As Good as Gold Australia. How are you this afternoon, John?
Doing well, sir. How are you going?
Very well, thank you. We are keeping up our commitment, John. We did state last week that our viewers would be seeing us more often this year, and here we are again. In today's interview, I thought we might talk about the negative impact that long-term low interest rates and ultimately negative nominal interest rates might have on Australia's and indeed the overall global economy. I mean, negative interest rates, John, what are they? What is that? And are we pursuing that policy in Australia?
So a couple of questions there, and obviously glad to be with you and Brian today. So negative nominal interest rates is basically when, so for example, if you've got $100,000 and you go into the bank today and put it in a term deposit, they're going to pay, the rate at the moment is about 2%. So after your 12 months, just say it's 2% per annum, the bank will pay you $2,000 interest on the principal. Well, if it's negative nominal interest rates, you have to pay the bank a sum of money for the privilege of putting your money in the bank. So it's basically the reverse of what we expect and understand banking to be today.
So how does that work? We're just not used to that at all. It's okay talking about low interest rates and buying property, buying cars and all of that. There's a huge incentive there to do that. But now we go to the saver, we look at the saver and say, well, there's no incentive for anybody to save at all.
So in the last 10 years, negative nominal interest rates has been introduced into the central bank monetary system. So first time in human history where this has ever been tried. Several countries around the world have implemented it. The lowest they've got is in Switzerland at negative 0.75%. And the purpose of negative interest rates is so basically you've got a whole bunch of countries with too much debt, and they've run out of options of how to try to stimulate or artificially stimulate economic growth. So when interest rates were high, you kept on cutting. Then you get down to like 1%, you get down to zero, and then you think to yourself, well, my economy is stagnant at 0%. How do we get some more juice into the economy to try to get people spending? Well, there's a whole bunch of people who are sitting on deposits. The central bank just thought, well, if we can get those deposits out of the banks and into the economy, either through consumption or investment, then that's going to artificially boost GDP in the short term, and that's why they introduced it. It was a mechanism to entice or force people to get the money out of the banks, to go spend, to go invest, because they think that savings is the enemy of economic growth, whereas in the non-Keynesian paradigm, savings is the starting point of why you have, in terms of long-term economic growth, in terms of a laissez-faire economy. So rather than consumption and debt building economic growth and prosperity on consumption and debt, the 19th century was built on savings, investment, production, and obviously trying to produce more goods and services and investing in productivity that actually led to a higher standard of living. So that's why the 19th century, if you look at the early 1800s and how Western Europe was living compared to where society was 100 years later in the late 1890s, early 1900s, there was a big leap in living standards, and it was on the savings, investing, production, productivity angle. And then particularly after John Maynard Keynes, they flipped the script and said it's all about consumption, it's all about debt, it's all about taking interest rates to zero. And because John Maynard Keynes was the first one in his book, The General Theory, to say let's take interest rates to zero. Well, after the GFC, they took interest rates to zero, and then they realised that they couldn't. That will work for a bit, but then the economy started to stagnate again, and they said, "Well, what else can we do? Well, let's try negative interest rates." And I think economically it's just madness, but they've tried it, and now they've realised that they need to go further beyond what they've already tried.
So, are we pursuing this policy in Australia, John?
Obviously, Australia hasn't had negative nominal interest rates yet. I mean, the official cash rate of the Reserve Bank of Australia is at 1.5%.
Yeah.
There is chatter that as we go into further choppier times, I mean, there's a lot of chatter now that we may see some rate cuts in July, maybe 0.5%. The Reserve Bank hasn't ruled out taking rates to zero. The Reserve Bank has already put on the table of launching quantitative easing if necessary. Now, the government and the officials have not said anything, but I have had private conversations with some members of the establishment in the last couple of years. I do know for a fact that Treasury and the Reserve Bank has looked at negative interest rates for Australia. They apparently believe that they can go to negative 0.5% with no problem, but beyond negative 0.5%, they think that there is a problem. And obviously, this is where the IMF in the last few weeks has come out with several papers. They came with some papers last year. They come up with some new stuff this year to overcome because negative interest rates so far has created some unanticipated problems, and now they're trying to come up with some new solutions to overcome those problems before they want to take interest rates much lower than where they are in places like Japan and Switzerland.
Obviously, on this topic of negative nominal interest rates and the requirement for it, it seems to me there seems to be a correlation between world debt, which seems to be increasing, and then the lower and lower of interest rates coming to fruition. So this correlation, I don't like what I see, but maybe you can add some comments to that.
So there is absolutely a relationship between interest rates, which is basically the amount of interest that you pay on the debt, and then the quantity of the debt. So obviously, from a mathematical point of view, the lower the debt, the lower the interest rate, well then obviously the lower the interest payments on the debt is, and that means that you can, in theory, take on more debt. Well, that's effectively what the world has done, and obviously, every time we've gone into a dip, so we've had, if you look at the in terms of the bull run of the bull market for US bonds, well, we basically started at a very high peak around 22% in the US in 82, 83. And since then, it's all been going downhill in terms of what the interest rates are, in terms of bonds, but also what the official interest rate is. So it started around the 20% mark, and now they took it down to zero. Like after the GFC, now they're back at 2.5%. But every time there's a recession, they go lower and lower and lower. So 2003, Greenspan took it to 1%. After the GFC, they took it down to 0%. And now they realize that if the US economy goes into another recession, well, in order to keep the debt bubble intact, they've got to go even lower. And that's why last week you saw an official for the US Federal Reserve saying that negative interest rates was not out of the question for America. So whether it's for America or Australia or any other economy in the world, well, if you're going to keep this debt bubble machine going, you've got to be able to continue to pump in more debt into the system. And the only way you do that is by lowering the cost of debt. And that's why negative interest rates is on the table as what they consider to be a legitimate policy tool going into the next crisis.
Dara.
To suggest, John, that we are entering an era where we're experiencing unprecedented change would be an absolute understatement. With change, understandably, there can be resistance. And in some countries with the introduction of negative interest rates, there has been resistance. Notably, a tendency for many individuals to do something that's come as a bit of a surprise, and that's to hoard cash.
Yeah.
So they take their money out of the bank so as not to be charged interest on their deposit, and are not spending it as the government would have anticipated, and so the money isn't going out into the economy. This, it seems, has now led to a war on cash. Can you explain what's happening there?
What you made, Daryl, is 100% correct. When Japan, for example, introduced negative nominal interest rates, the number one consumer item was actually safes. Japanese citizens were installing safes in their houses, and they made they asked the logical question, which is, why should I keep cash in the bank and pay the bank money when I can just withdraw the cash, hold the physical notes, and put it in my private safe, and I don't have to pay anything? So to the average Aussie, if you're holding $50 in your wallet, ask yourself what nominal interest rate you're paying on that cash, and the answer is zero. So basically, no one is paying you interest, and you're not paying anyone interest. So this is the unanticipated problem that came up when they started to roll out negative interest rates, which was that people would hold cash, because holding cash is basically the interest rate on holding cash is actually above the negative interest rate. So obviously they said, well, now physical cash is a problem in order to make this negative interest rate system in terms of it being effective. So what they've tried to do around the world is institute a war on cash. And that war on cash has played out in several ways in terms of, for example, eliminating notes or making transactions above a certain amount illegal. So for example, if you go to Italy, it's illegal to transact above 3,000 euros. If you go to France, I think it's illegal to transact above 1,000 euros. In Spain, it's about 2,500. Or if you look at India, they tried to eliminate certain notes. And 2016, they tried to eliminate 86% of all cash in the Indian economy. But also, for example, if you look at the European Central Bank, they've tried to stop the printing of the 500 euro note. So these are all examples of trying to reduce the quantum of cash that is being used in the economy. And obviously an important part of this agenda has been encouraging more citizens to use digital forms of payment. So obviously we've got the credit cards, we've got in terms of electronic banking. So they've been around for a while, but obviously you're starting to see new technological applications like paying. Rather, if you don't need your wallet, if you've got a particular app, you can pay for your meal using your phone. So Apple ID and all of this sort of stuff. So there's a new technology coming out that will encourage people to use digital forms of payment rather than using physical cash. And all of this is to trap citizens in the digital system, so once they can eliminate cash and everyone's trapped in the digital system, well, then they can do and control citizens any way they want using interest rates and a whole bunch of other policy measures.
Quite effective though, John. I mean, like I went to the grand final last year, the SANFL grand final here in Adelaide, and I don't go to the football a lot, so I was caught by surprise when I withdrew some cash from my pocket to pay for a drink, and they wouldn't take it. They couldn't take it. So every transaction now at Adelaide Oval has to be done with a credit card. So they are having their way about this, aren't they? I mean, it's slowly but surely creeping in on us and having the desired effect, I would think.
There's clear evidence that more, particularly in the large business sense, because I mean, they would argue that it's more efficient and cost effective not to accept cash and to have everything in terms of using electronic systems. But I mean, there was actually an example in the last fortnight where there was one city council, I think it was in Philadelphia, who basically they introduced a new law to make it illegal to have cashless stores in the city. So there was one bright spark in America in the last 2 weeks where they said, no, every retail store must accept cash. But apparently, unfortunately for Australia, the trend is to try to reduce cash in the economy. And we've got the Reserve Bank calling for a near cashless society. So now, late 2016, the Turnbull government announced a Black Economy Task Force. And basically, I wrote a piece for the Daily Telegraph at that time. Basically, the argument, and this is a very superficial argument, is they're trying to say that the amount of, people are using cash for all sorts of illegitimate purposes, from narcotics to gambling to buying illegal tobacco or to avoid tax. And so they said, well, if we want to boost tax revenue, if we can eliminate the use of cash in the economy and everyone has to report what they're really doing, well, that honest reporting is going to lead to an increase in tax receipts. Now, there is some limited evidence of that in India, but the amount of non-compliance with the Indian tax system before they introduced their war on cash was quite substantial and much more. It was a much more larger problem than what we have in Australia. But in my view, this was a facade to launch this domestic war on cash, because the black economy has been around for basically since the first fleet have been here. And they have had ample decades to try to address the war on cash try to address the black economy if they wanted to. There were claims that when they introduced the GST, that the GST would reduce the black economy. And then I think there was evidence to suggest that the black economy actually increased when they introduced the GST. So they've had 20 years to actually do something about this if they wanted to, but they just so happen to say we need to address the black economy at the same time when all of the international banking academics saying we need to eliminate cash so we can make negative interest rates to work. So they introduced this Black Economy Task Force in 2016, and in 2017 the Black Economy Task Force delivered their final report. They had a whole chapter about the use of cash in the Australian economy, and they basically came up with a range of suggestions around how to drive the amount of cash in the economy to basically record lows, including one of the recommendations which was accepted by the Morrison government, which is to impose, and this was announced in last year's budget, it was to impose to make it illegal in Australia to transact in cash above $10,000. Now, that rule was supposed to be brought in by middle of this year, but with the mid-year economic forecast outlook that was released in December by the government, they in that document they said that rule has now been delayed until January 2020. So now, because it looks like we're going to have a shortened government, a Labor government, we'll have to see what Labor does in terms of this rule. But as we speak, there is an intention to introduce legislation into Parliament to make it illegal that any cash transactions above $10,000 will be illegal in Australia.
Yeah, John, we've covered some international war on cash and the Australian war on cash. And what does shudder me, it shudders my thinking when you mention the fact that we've got creating a black economy task force. I can see this leading to a little bit more than just a task force, because I was watching the news here in Australia, especially South Australia and Adelaide, and the Surf Lifesaving Club have introduced drones to go up and down the shores to make sure we protect our swimmers. And I said to my wife, this could be just the beginning of the application for drones. I can see the application of drones not flying over the beach shores of saving swimmers' lives, but also over households and commercial places where a little bit of cash does fly around. And I think under a black economy task force, I shudder to think the size of a government department that can put that together. Your thoughts again?
Well, yes. So we are seeing an increasing trend right across Western democracies to increase the power of government, to have more control over citizens, whether it is in the economic or in the non-economic sphere. The war on cash, the reduction of civil liberties. It's all heading in the one direction, it's not bearing well. But obviously, you're starting to see signs of resistance. So whether it is the Yellow Vest movement in France, or protest movements in other other sort of countries around the world. You are getting a point where politically and socially, a lot of these attempts to control citizens' lives. It's really coming up to the point where people are saying, that we've had enough. If there was now. So far, this war on cash in Australia is being done in a very soft and gentle and gradual way. But if it comes to the point where they're really clamping down on people's freedom to transact privately with whichever party they want to, you're going to see more resistance coming from, I think, the Australian people. And that won't be good for political harmony and political cohesion and social cohesion. But these are the consequences when you try to trample on the freedom of free men.
Yeah, I agree with you. I think we'll have similar things to France with the yellow vests. I don't think it's not going to be easy for the Australian public to accept the fact that they're going to be photographed or, looked upon as if they're doing some devious deal just because they're handling cash. I think the Australians will knock that one back, or certainly take a lot longer to come to be, let's say, helpful for the government in that manner.
John, I would like to hear your views on a new initiative, a new payment platform, NPP. Can you explain how that process works?
So in Australia, you've got a sort of digital infrastructure that basically links up the central bank to all the banks that sort of process, that process all the payments in Australia. So the old framework was quite old, disjointed. So, for example, when you deposit a check in someone's account, it takes 3 days to clear. A lot of this has to do with the way the banks and the central bank interacts and how quickly payments can be made. So there was an initiative launched by about 8 or 9 banks and a couple of private sector bodies, but including big 4 banks and Macquarie and a few others, plus the Reserve Bank, where they all said, let's actually invest some money to create a new modern digital infrastructure platform, and they've called it the new payment platform. And basically, this is an attempt to make digital payments much more efficient. Now, they introduced this not because so this wasn't directly tied to the war on cash, because they just said to have a modern banking system, we just need new robust infrastructure. But now that so this new payment platform was introduced in February last year, and so there's anyone can look this up, the new payment platform. They actually established a new company that's running the infrastructure. It's been up for about 12 months, and 400,000 payments or transactions have been processed by this new payment platform in the first 12 months. And every month that the platform is in operation, the volume of transaction goes up. So we do have, so the banks and the central bank has new infrastructure to use to make things much more transparent, and things can clear and move from account to account almost instantaneously. But now that they've got this infrastructure, it actually gives the central bank and those who wish to eliminate cash from the economy, it gives them new tools of how to achieve that. So this new payment platform, it wasn't intended to be an arrow in the war, for those who wish to eliminate cash in Australia. But now that it's here, it has a lot of applications which can make things, it can give them much more options. And I think what we're going to see is you're going to see a whole host of commercial entities bringing new applications to the market. I mean, some of that happened last year. You'll see more of it this year and next year, where there'll be new ways to pay for things without using cash. And a lot of people will fall into the trap of thinking that all of this is good. This is all making human progress.
So, John, what they're doing is they're making cash look clumsy, aren't they? That's really what they're doing. Very effective. Yes. Brian.
Okay, there's also another point here, an alternative solution, dual local currency system. And I've been reading the notes, and I want, if you could explain a little bit further, but what I want to bring up here is that, again, the IMF become a part of this whole scenario. In fact, it's more than the IMF. It's IMF, the governments, central banks introducing a dual local currency money. What surprised me was the fact that if there's an exchange rate between electronic money and cash money of, let's say, 0.95, if you're depositing $1 million in cash, you actually don't have a deposit of $1 million. It could be as low as 950,000. Am I reading this right, John?
Correct. So the IMF, they published a detailed academic paper last year, but also several weeks ago they released a new blog, basically trying to say we need a new solution of how to make negative nominal interest rates work, because they've realized that eliminating cash completely will face too much political resistance. So there are some countries where the war on cash has been more successful because there's been less citizen, there's less resistance from citizens. So one example could be Sweden, but there's other countries where they're going to put up like a stiff fine. So they said, well, how do we, without eliminating cash, is there another way that we can do this? And the solution they've come up with is what they call a dual currency, local currency system. So basically what they're going to say is that there's two forms of currency. There's an electronic version and there's a physical version. And basically the official unit of account is electronic money. And basically they're going to effectively impose a cost to hold physical cash. So what they're going to, this is the proposal, is to implement a exchange rate or a conversion rate between digital money and physical money, and basically make those who wish to hold physical cash that they will have to pay a cost. So just like you said, if they impose a particular exchange rate, it could well be that you've got $1 million in cash, you've deposited it into the digital system, and that representation in the digital system only is what, $950,000. So now, now, if they introduce that, they can obviously manipulate the exchange rate between digital and physical cash, and they can reduce the cost of holding physical cash, or they can increase the cost. But that is the supposedly silver bullet of how they get to, because what they've said is, and we really haven't touched on this, why do they want negative nominal interest rates? I mean, so basically, the RBA is at 1.5%. A lot of other economies is at 1, 2, 3% in terms of negative interest rates. And they've all said if we go into a deep recession, historically you need to cut rates between 3 to 6% to try to stabilize the economy. Well, if everyone's trying to cut between 3 to 6%, well, you have to go negative, and you have to go deep negative, like -3, -4%. So that's why. So in order to avoid a global depression, that's what the IMF is saying. We need to go to -3, -4. But because we don't have a lot of room left before we hit the zero bound, and basically they're now thinking if we introduce this dual currency system, that could be the silver bullet. And the RBA governor has already talked about having a Australian sort of token and a version of the Australian dollar, so electronic money, versus physical cash. So that they've considered that hasn't gone anywhere yet. So we don't know exactly what they're doing inside the RBA, but it looks like that could be potentially the next new wave of potential policy coming out from governments and central banks, because we're all getting ready for this crisis, and they're thinking, well, how do we make this negative nominal interest rate system work? But the surprising thing is that obviously they're running out of time, because I think the crisis is coming perhaps faster than what they think, and they still haven't got all the pieces in place to really take interest rates low.
Yeah, to finish that subject off, I think because, as you've said, governments need interest rates of around 3 to 5% to counter a recession. It's not going to take too long before we get to -5% in this scenario, and who knows what happens after that.
And Brian, look, actually, that's a very important point, because even in this IMF paper that they released, they said if we go to -4, -5% interest rates, we don't fully know what that actually does. I mean, they think now they don't know, but they think it's going to stimulate economic activity. But when it comes to what does this mean for financial stability in terms of the global financial system, they openly say we don't know. It's never been done before. We have no data. So there's a lot of unknown answers to some of these questions, and basically there's a lot of guesswork. And they could try this and it could blow up, because again, never been done before. They don't have all the answers, and you've got a whole bunch of ivory tower academics who are just throwing darts at a board random and saying, well, okay, how do we solve this? Why don't we try ABC, and let's hope and pray that it works.
I would think that if we go to -5, we got a disaster on our hands, simply because I've always looked at economics and say, okay, the money comes from the reserve banks of Australia or the United States Federal Reserve, and there's an interest to be paid on every single dollar printed. So it tells me the fact that the more they go into negative interest rates, the quicker this whole thing's going to blow. Daryl?
Well, it's pretty clear to me right now, and I think the viewers, that there are a number of policies that have been introduced to prepare us for a possible introduction of nominal negative interest rates in Australia. So we've already acknowledged, it's been quoted a couple of times already in this discussion, that interest rates are at 1.5%. That means the RBA has very little room to move to create a monetary stimulus like they did in 2008. So, what do you believe, John, is the likelihood of negative interest rates in Australia in the very near future?
Chances are pretty high. So I think the first thing we're going to see is, probably over the next 12 to 18 months, we're definitely going to go to zero. I definitely think we're going to see quantitative easing probably 2020. Now, the question is that, we're seeing the housing market starting to unravel. The Australian Bureau of Statistics released started today around housing lending. So property prices are going to fall faster than what the government and some of the banks officially have anticipated. And we're going to start to see people panic. And we don't exactly know how quickly all of this debt bubble is going to unravel, but the RBA will move heaven and earth to stop a depression and to keep the debt bubble intact. So if they go to zero, if they implement quantitative easing, if Canberra spends enormous sums of money to prop up the economy and to bail out some of the banks or the mortgage-backed securities, the question is, if that works, well, maybe we'll be spending negative interest rates. If it doesn't work, I think every Australian should be ready to read the newspapers one morning, and they'll see that the Reserve Bank has cut interest rates to -1/4 or -1/2, or maybe they've even done something more extreme than that.
I guess what we've got to do here, John, is keep in mind that, as is the case with devaluing currencies, negative interest rates is a form of stealing. It's a form of stealing, in this case, from the Australian population. It's like a thief in the night, slowly eating away at your reserves. That's really what it is, isn't it? So we've really got to keep that, we've got to understand it. Once again, a perfect environment, I would think, for the consideration of precious metals. Historically, 5,000 years, gold, is the ultimate store of wealth. We keep on saying it, we refer to Jim Sinclair regularly, but Jim says, if you want to preserve your wealth, just do what the major central banks of the world do. They own gold, and they do it for particular reasons. So they buy gold, that's why they do it. Why not us? How say you?
So I agree. We know that the central banks in 2018 saw the largest amount of net purchases in gold since 1967. A number of central banks see, because all the central banks, particularly in the non-Western world, Russia, China, Eastern Europe, in terms of the Middle East, India as well, they all can see the writing on the wall for the US dollar, the current international monetary system. They see that there is enormous amounts of systemic risk, and they say, well, we need to hedge our risk. And rather than, so during this fiat currency system, what have they been using in terms of the hedge? They've been using US Treasuries. Well, now, the confidence in the US dollar, US Treasuries, the US government, Congress, it's all starting to wane and say, well, we don't trust it anymore. We need to trust something else. Well, everyone's gone back to gold. But not only gold, the Russians in particular, the Russian central bank are starting to hoard silver in very large quantities. I guess, I wouldn't be surprised if we see more central banks start to hoard physical silver on top of gold. But yes, it's still in large sense, gold is being hoarded at increasing rates in 2018, 2009. We'll see it more in 2019 and 2020. And I anticipate that we'll see either central banks or large institutions or high net worth individuals or families start to hoard silver as well. I think that it's been underway for several years, but I think it will intensify as more of the weakness of the US dollar is exposed in the months to come.
John, you were going to say something, Brian?
Yeah, well, it was just interesting to say, because I've been talking about the IMF today because on the subject matter, and isn't it interesting how the IMF, after America, Germany, the IMF is the third largest holder of gold. Right? They're making sure they're in the right place if something goes wrong in their decision making.
I was going to say, once again, John, it's that time again at this point in the interview. I would really like to thank you so much for your contribution today. It's always educational, always thought-provoking. Really appreciate your input. But before we go, I would like to ask you if you've got any closing comments that you'd like to contribute before we go.
So in terms of the topic that we're speaking about today, I mean, look, so again, I think a lot of Australians watching this who may not be fully across negative interest rates or anticipating that this could happen, I'd encourage people to go onto the internet to research. You'll find that many central banks already around the world have already introduced it now and have been having it implemented in terms of over the last few years. Go look at the IMF. Go look at their paper from last year, their blog from about a month ago. As Good as Gold Australia is going to publish an article soon of an article that I wrote about this topic. So there's a lot of information out there, and I think people should be across this issue before it's implemented and it starts to affect people's portfolios and their wealth.
Thank you, John. Thank you for that.
Thanks.
Look, a reminder to all of our viewers that we do have a GFC 2.0 conference coming up in Melbourne. It's on a Saturday, April 27, and in Sydney, Saturday, May 4. Now, John is, of course, the major keynote speaker at that event. So that gives all of you a chance to connect with John at a different level. All of these seminars are remarkably successful and just a wonderful chance to be educated on this subject. Details, of course, are listed on the link below. And finally, and most importantly, thank you once again to all of our subscribers for your valued support. Until next time, stay well, stay focused, catch up soon. Bye for now.
Bye for now.